Hi everyone, this is Aleena Kareem. I'm your expert tutor for the financial reporting exam. In this particular video, I'm going to cover a very important topic which is related to leases. IFRS 16 is something which deals with leases, but in our financial reporting exam, only the lessee accounting is tested. So in this particular topic explainer video, I'm going to dissect in great detail how lease is accounted for at the beginning of the lease, initial recognition time, initial measurement time, subsequent measurement, subsequent recognition, how all of that is going to take place, we are going to cover in this particular video. Leases is a topic which is very important for your exam because very frequently a small maybe 2-mark question can come up from it. It can be in the section A of the exam or the section B of the exam. When we talk about section C of the exam, it normally comes up in the final accounts question where it is available as an adjustment. It can also come up in the interpretation question, specifically when we are dealing with ratios like gearing which change when lease treatment is there. Also, with respect to lease, there is interest expense, and that is something which impacts other ratios also. So this topic can be tested anywhere in the exam, and we are going to cover all that is there for you with respect to the financial reporting exam in this particular video. I'm going to suggest you additional practice also because this video is not going to cover everything in great detail, but I'm going to touch upon all the accounting treatments and recommend the practice material as well as the reading material for you. So let's start accounting for leases. Let's start with what's in the syllabus with respect to lease. Now, IFRS 16 is a comprehensive standard, but from the financial reporting exam perspective, we have to focus on accounting by the lessee only. And in the accounting for lessee, there are two subparts. One is the standard accounting model and the other is the simplified accounting model. And other than that, there is sale and leaseback, which is a slightly tricky area. In this particular video, we are going to cover both the accounting by the lessee in general and the sale and leaseback working also. We'll be looking at both the accounting models as well. Now in the accounting by the lessee, we'll start off with the simplified model. Now, in case of simplified model, we need to see two conditions. Number one is that is the lease term 12 months or lesser with no option to purchase the asset at the end of life? And second is the asset low value? Now the standard does not exactly specify what it means by low value, so it is going to vary from company to company with respect to materiality. But these two conditions are evaluated. If these conditions are met, then we can apply the simplified model of accounting on the lease. Now, in case of simplified model of accounting, if we are talking about an asset which is of less than 12 months, then we can recognize them by class. And if they are of low value, like we talk about cell phones or tablets, then we need to classify them on a lease by lease basis. And when we are applying the simplified model, the calculation is done simply by taking the total lease payments, distributing them over the lease term, and identifying whether there is an accrual or prepayment related to that at the year end. It is more like how we account for the rental expense. Now, if these two criteria are met, then we have the simplified model. Otherwise, we have to recognize all the lease agreements as per the standard accounting model. Standard accounting model is something more frequently tested in our exam. In the simplified model, at times we have had questions which are of in the section A or section B of the exam. Now, over here in the standard accounting model, let's see how accounting is done. This is the model in which we have to do the classification of lease at the commencement, and all the accounting treatments are done with respect to the initial recognition and measurement criteria. Now, when we have a lease, lessee is the party who has received the asset and is going to pay against it in installments. So from the lessee accounting point of view, we are first going to recognize the right of use asset. So on one hand, the lessee has the asset. So right of use asset is going to be recognized. On the other hand, the lessee has to pay installments against the lease, and therefore lease liability is recognized. So when we talk about the standard accounting model, there are going to be two different dimensions of accounting. One part of accounting is going to relate to the asset side of the lease, and the other part is going to relate with the liability side of the lease. When we talk about the right of use asset, so on the very first day we are going to recognize it as a non-current asset, and then subsequently we are going to depreciate it like all other non-current assets. Whereas in case of liability, on the very first day we recognize the present value of future lease payments as the lease liability. There are some other components also, we'll discuss them shortly. And then as the years pass, we recognize interest expense on this lease liability and the installment paid are recognized. Now, in our accounting system, so remember that a few very important calculation parts are the recognition of right of use asset, the recognition of liability, the depreciation, and the recognition of interest expense in statement of profit or loss, and repayment by decreasing the liability value in the statement of financial position. Now, moving on to how lease liability is recognized in the financial statements. So basically it is the present value of future lease payments. And in these cases, if there is any incentive, that is subtracted. So actual value of payments is taken and then they are brought at present value to recognize the lease liability today at the commencement of the lease. Now, in this case, when we talk about future lease payments, what are the payments which are included? So we have fixed payments which are installments that have been committed by the lessee. Then there is fixed in substance payments. So these are the ones in which there may be a lease contract that may say that the lease payment is based on sales revenue. And so the company is going to pay extra if the sales level is higher. However, they say that a minimum amount of, let's suppose, $1,500 per annum is going to be paid. Now, this $1,500 per annum amount is going to be fixed in substance, and that is going to be added to the lease liability. Then there may be some payments which are variable and they are dependent on the rate or any particular index that is there. For example, if we talk about RPIs, so those variable lease payments are also going to be added in the calculation of present value of lease liability. However, if there is any payment which is linked to the sales, that is excluded from the value of the lease liability. Then if there is any early termination penalty, then we have to see if it is reasonably certain that the lessee is going to opt for it. If that's the case, then that is also going to become a part of the lease liability. We also need to see if there is an option to purchase the asset at the end of useful life. Again, if it is reasonably certain, only then we are going to include it in the calculation for lease liability. And all of these workings are going to be estimated at the commencement of lease because that is the time when the lease liability is initially recognized. So initial recognition is done the commencement of lease, and all of these criteria that we have discussed with respect to the amounts which are included in the value of lease liability, these come under the initial measurement criteria of lease liability under IFRS 16. All of these payments, once they have been calculated, we calculate their present value, and the discount rate that is used for the calculation of present value is the interest rate implicit in lease. However, if this rate is not available, the interest rate implicit in lease, then we use lessee's incremental borrowing cost for the calculation of present value. In your exam questions, this rate will be given to you. You just have to do the calculation of present value accordingly. In most of the cases, even the factor will be given in the question, because the examiner wants to test your concepts with respect to lease rather than being very calculation focused. Now we come to the second part of the lease accounting. Just a quick reminder, we are doing lessee accounting in the financial reporting exam. Lessee is the person who gets the leased asset from the lessor and against that commits to pay a certain amount over a period of time. The liability part, we just calculated how we are going to work on it from the lessee perspective. Now we move to the second side, which is related to the right of use asset. So the asset, the leased asset that the lessee has obtained, how is it accounted for in the financial statements? The initial measurement of right of use asset consists of the calculation starting off with the present value of lease liability. There's nothing new in this lease liability. It is the amount that we have just calculated in the previous slide. Then, if there is a payment which has already been made, that does not become a part of the lease liability. However, while calculating the value of asset that the lessee has taken, this payment is also going to be added. So any payment made in advance will become a part of the cost of asset. Any incentives which have been received are going to be subtracted. So any special discounts or incentives, they are going to be subtracted from the value of right of use asset. Any direct costs are going to be added to the right of use asset, just like we do in property, plant and equipment. And if there are any future costs related to dismantling of this particular leased asset or its site's restoration, then the present value of these costs is also taken and it becomes a part of the right of use asset. If you see, this calculation is very similar to how we calculate the value of property, plant and equipment in general also. So all of these payments are going to be taken up, and then the final value is going to be the value at which the right of use asset is initially measured in our financial statements. This is the value with which we debit the right of use asset and subsequently charge depreciation on it. With respect to the credit side of this entry, so we debit the right of use asset with the whole amount. Against that, we credit the lease liability that we have calculated previously. We credit the bank with the amount that has already been paid. Any incentives received, they are debited in the bank. Any direct costs are credited in the bank, and any future costs, against them a provision is created, just like we create the provision of dismantling or site restoration in IAS 16. So remember the double entry in mind, and that will make your working easier. These concepts can be tested in a narrative form as well as in numerical form. These have come up in the OT cases. Mostly in OT cases, there is a higher chance of having a narrative question also. Again, this part is not just limited to the section A and section B of the exam. Rather, it can come up in the section C also as an adjustment to the final accounts or as a part of the interpretation of financial statements. Always be careful in interpretation questions. If a leased asset has come in, if the lease liability has increased, because that impacts gearing. If leased asset has been given back and the lease liability has been paid off, that also has impact on various ratios which are related to interest expense as well as the non-current liabilities of the business. Now, once we have calculated the value of right of use asset, we need to charge depreciation on it. The calculation of depreciation is as per the methods that we have already seen in IAS 16, the straight line method, reducing balance method. But the twist over here is identifying what is the useful life that we should use for the calculation of depreciation for the right of use asset. So IFRS 16 says that if the ownership transfers at the end of lease term, then in that case, the depreciation of right of use asset should be over its useful life. If purchase option is available and it is reasonably certain that it is going to be exercised, then also we are going to use the useful life for depreciation. If this is not the case, then we use the shorter of useful life and the lease term for the calculation of depreciation. So please notice in your question what kind of situation has been given to you. Let's solve a question from the practice exam in your practice platform. Over here, you have a short question, which is an OT question. So Sheba Company enters into a lease for a right of use asset on 1st January 2007. The dates are very important in lease questions. The lease contract is for 4 years and the useful life of the asset is 6 years. Information relating to the lease is as follows. We have initial lease liability, deposit paid, direct cost, maintenance cost. The question is saying what will be the carrying amount of right of use asset. So over here, initial lease liability is going to be a part of the right of use asset. Then deposit paid. So any advance paid, that is also added to the right of use asset value. We've just covered this. Any direct costs are also added to the cost of asset. However, maintenance costs do not become a part of the right of use asset value. So based on all of this, we can identify that 55,000 is going to be the initial measurement of the right of use asset. Over here, the question is saying that the acquisition was done at the 1st January 2007 of the leased asset, and the question is asking you to calculate the carrying amount of right of use asset at 31st December 2008. So this means that the asset was obtained 2 years ago, and now we have to tell the examiner the value after 2 years from the commencement of the lease term. Because the overall life of the asset is with respect to the lease term, it is 4 years, so we are going to use it as a useful life. 2 years have already passed, so the depreciation of 27,500 would have been charged, and the balancing figure is also 27,500, which is going to be the correct answer in this particular case. Now, when we talk about the subsequent measurement of the leased asset, which is the right of use asset, we always charge depreciation on the depreciated cost, which is the carrying value, except if the right of use asset is in the class of property, plant and equipment, which is going to be revalued. So as the criteria of IAS 16 says that if a particular class of assets is being revalued, then all the assets in that class are going to be revalued. Same is the case with right of use asset also. In such cases, now depreciation going forward is going to be charged on the revalued value. Secondly, if the right of use asset is investment property of the business and the company uses fair value model for IAS 40, which is investment property, then the right of use asset is also going to be measured at the fair value model, and no depreciation is going to be charged, because in fair value model, at every year end, fair value is calculated and gain or loss is charged to statement of profit or loss. Here you can see the working for both the models. Now, as we discussed, at the commencement of lease, we have right of use asset and lease liability. Subsequently, right of use asset is depreciated, and against the lease liability, we recognize the interest expense as well as the installment payment. So we have covered different parts of this, but now we need to see that how lease liability is subsequently recognized in the financial statements. We've covered the right of use asset and its depreciation, initial value, as well as the subsequent measurement. Now we are going to see that initial measurement of lease liability that was done, how is it subsequently recognized in the financial statements. So accounting for lease liability, there are two cases. We may be making the lease payments in arrears, or we may be making them in advance. The accounting treatment varies if the payment is being made in arrears or in advance. We'll start off with payment being made in arrears. Now, if we have a brought down balance of lease, we charge interest on it because the time has passed, and at the year end we are going to make the payment. So as the time passes, we recognize the interest expense. Over here it was at 6%. This 2585 value has been calculated by multiplying 6% with 43082. Then at the year end, we make the installment payment, which is 10,000, and the balancing figure is the carried down balance. So brought forward plus interest minus the payment, a balancing figure is the carried down balance. Now this 6% is the interest rate implicit in lease, just as we discussed before. This interest expense is going to go in the statement of profit or loss. there it is going to be shown in the interest expense, which is subtracted after the profit before financing and income taxes, and the liability, which is the carried down balance, is going to be shown in the statement of financial position. This liability needs to be distributed between the non-current liability and current liability. This is the tricky part as to how do we calculate whether how much of this amount is going to be shown in the non-current liabilities and how much is going to go to current liabilities. So please see this very carefully, that the non-current liability is going to be next year's figure after payment. So it means that when we talk about the closing balance of liability, we are going to see how much of it is going to be paid in the next year, and the working which is going to be there with respect to liability at the subsequent year end, that is going to be the non-current liability. I will repeat this for you, that while we are calculating the non-current liability, we always need to do the working for the next year also. And once we do the working for the next year, the closing balance of the next year is going to be your non-current liability. This we are talking about payment in arrears. Whereas the current balance is going to be a difference between the carried down balance at the current year and the carried down balance in the next year. So in this particular example, at the end of year 1, we had liability of 35667. We subtract from it the liability at the subsequent year end, which is 27807, and the balancing figure is going to be your current liability. Now, the interesting thing is that this is one way of calculating the current liability. Another way of calculating the current liability is by calculating the difference between the payment in the next year and the interest. Because when we talk about the current liability, it can be calculated by taking the next year payment less any interest which has not yet accrued in it. So if we talk about at the current year end, this 2140 interest has not accrued. So we subtracted from this installment to be paid of 10,000, and the balancing figure that we get is the same 7860. So these are the two methods for calculating current liability, and non-current liability can be calculated using the working for the next year of the lease liability. This was for payment in arrears. Now, if the situation was changed and the payments were being made in advance, then in that case also we need to do the working of interest first and the installments. Then we have a brought down balance. Immediately from that, installment is paid, so payment is subtracted. The carried down balance that we have on it at the year end, we charge interest expense. In the same way, we apply 6% to this carried forward balance, which is 25609. And once we have the interest expense, it is added to the carried forward balance, which is 25609, and it gives us the closing liability of 27146. Now, this liability is going to become the opening balance of the next year, and immediately on the very first day, we are going to make the payment of the next installment. So 10,000 is going to be subtracted. Remember, in this 10,000, we have interest expense also, which is of 1537. Same method is followed in the next year also, and we get the carried down balance of 18175. Now, in this case also, the interest rate implicit in lease was 6%. This is the amount which is going to be shown as an interest expense in the statement of profit or loss. And this carried down balance, which is 27146, this needs to be shown as a liability. We have to bifurcate this liability also in current liability and non-current liability. We are going to use the method that we calculate the liability which is going to be there after the payment of the installment, which was at the start of the year. Now, once we have made this payment, then the amount that is going to be left behind is the non-current liability. Please remember, the interest accrues over time. This 1029 was not there as a as the amount of the principal payment of the lease. Rather, this is something which is going to accrue over time. That amount which is going to accrue over time, that is not going to be a part of the non-current liability of the lease. So we calculate the closing balance. From this, we subtract the next installment which is going to be paid in advance, and the balancing figure is the non-current liability. Now, with respect to current liability, the formula is the same as we used in the payment in arrears. That to calculate the current liability, you take the closing liability, from that you subtract the non-current liability, and that is going to lead you to your current liability. Over here also, it is very important that we identify the immediate amount that is going to be paid, and that is 10,000 including the interest expense of the previous year. But now this interest has already accrued and it is a part of the installment payment. So this total 10,000 balance is going to be shown as our current liability. This includes a portion of the principal repayment of the lease amount as well as the interest expense. Now let's apply the learning to a past exam question. This was actually specimen exam on the practice platform of ACCA. It says that on 1st October 20x4, Flash Company acquired an item of plant under 5-year lease agreement. Under the terms of the agreement, an immediate deposit of 2 million is payable on inception of the lease and the present value of future lease payments. At that date, it has been calculated as 25272,000. Annual rentals are of 6 million, are payable on 30th September each year for 5 years. The agreement has an implicit interest rate of 5%. So now they have told you that on 1st October, it was the acquisition which was done, and the rentals are being paid at 30th September each year, which means that this is a case of payment in arrears. The question is asking you to calculate the current liability for the leased plant. Now, the examiner can give you anything, current liability, non-current liability. You should be able to calculate everything. The reporting date at which we are working is 30th September 20x5. So this is 1 year after the acquisition of the leased asset was done, and very importantly, the examiner is asking you to calculate the current liability at 30th September 20x5. So from the commencement of the lease, which was on 1st October, 1 year has passed, and after 1 year, the examiner is saying what is the current liability. This is the working that we are going to follow. So we had an opening balance of 25272. We applied 5% interest rate on it. We subtracted the payment, and the balancing figure is the carried down balance. Now that becomes the opening balance in the year 2, which is 20535,600. Again, we charge interest expense on it for the year, subtract the payment, and we have the carried down balance. Now, our rule with respect to calculation of current liability that we just covered was that you calculate the difference between the closing liability at the current year end and the closing liability which is going to be there at the next year end. The difference is going to be your current liability. And the second way of calculating the same balance was that we subtract the interest expense from the payment which is going to be made, and this is the amount which has not accrued yet. So when we are standing at the end of year 1, the interest rate of 5% has not accrued yet. We subtract this amount from the installment payment and we get the same answer, which is 4973220. So you can use any of the methods in your exam, whatever you are more comfortable with. From the perspective of presentation in statement of profit or loss, we have the profit before financing and income taxes calculated. From this, we then subtract the interest expense on borrowings and lease liabilities. These are called financing activities, and after that, the amount that we get of profit, it is called profit before income taxes. So please make sure you place it properly in the statement of profit or loss. Now let's quickly solve one more question. This is from the Study Hub revision objective test questions. It says that JetSam entered into a lease for an item on 1st April 20x0 which required payments of 15,000 to be made annually in arrears. Present value of the lease payment was estimated to be 1,00650. At the inception, rate implicit was 8%. Both the lease sum and plant estimated life are 10 years.
The question is saying what are the total amounts that should be charged to profit or loss for the right of use asset for the year ended 31st December 2020. So very particularly they are saying what are the total amounts to be charged to profit or loss for the right of use asset. Total amounts mean that all the items that are related to the right of use asset, they have to be charged. So this is depreciation, and on the other hand, if we talk about the lease in general, that would have constituted of interest also. This is the working for both depreciation and interest expense for 9 months. The twist once again is that the total amount was written. We are not just going to charge depreciation and we are not just going to charge interest. Rather, a sum of both is going to be taken, and that is going to be the final answer. Please be very careful about it in the exam, because when this total amount is there, it means always that there is more than one item that is going to be charged. Interest is also related to the lease, so a part of the right of use asset arrangement, that is going to be calculated, and depreciation is straightforward. Now we come to the last part of this lease topic, which is sale and lease back. In case of sale and lease back, the important thing is to identify whether the transfer is a sale or not. If the transfer is not a sale, then ultimately we need to show it as a retained asset in statement of financial position. IFRS 16 says that the criteria of sale is to be followed as per the criteria of IFRS 15, which deals with the revenue from contract with customers. So if the control has passed, then it is a sale. If the control has not passed, then it is not a sale. If it is not a sale, then you need to show it in the statement of financial position, and whatever amount has been received against it, that needs to be shown as a financial liability. So debit bank for the amount that has been received against the asset, and credit financial liability, which is now going to be used later on to pay back the amount which has been received. If the transfer is a sale, then we need to de-recognize the asset, we need to recognize the proceeds, recognize the gain or loss on disposal, but the amount which is related to the portion of asset which has been retained, against that we need to recognize the right of use asset and the lease liability. The calculation needs to be done. Let's take an example for a better understanding of this concept. The carrying amount of an asset prior to sale was 250,000. It was sold for 300,000, which is the fair value, and the lease liability is 210,000 when it was immediately leased back. We're assuming that the transfer was a sale in this particular case. Now, if we talk about the double entry, the debit was to bank for the amount that has been received. The credit would be to property, plant and equipment, which now is no longer in the business because it has been sold. Lease liability we know for sure because we have leased the asset back to 10,000. What we are unclear about is the right of use asset and the gain or loss on disposal. Now, in this case, we need to do two workings. One is to identify what is the proportion which has been retained of this particular asset and what is the proportion that has been sold. For the proportion that has been retained, we calculate the liability and divide it by the sale price, because you see liability is also at present value and the sale is also at fair value. So 210,000 divided by 300,000, this is going to give you the amount of proportion which has been retained, and the proportion that has been sold is 90,000 out of 300,000. 300,000 is the fair value. Technically speaking, the present value of the liability should be equal to the fair value, but however, in this particular case, because we have retained only a portion, so that is less, we calculate the percentage of that portion through these fractions. Now the value of asset was 250,000. If we apply these fractions on that value, we can identify that the portion retained is 175,000, and this amount is going to be shown as the right of use asset value. On the other hand, the gain which was obtained by selling this particular asset, an asset which was worth 250,000 was sold for 300,000. So overall gain was 50,000, but only we are assuming that 90 divided by 300 was sold. This was the proportion sold. So we'll apply it to the gain or loss on disposal and calculate the profit on disposal. That is now going to be our answer. So in your exam also, you need to remember the formula, apply the formula to identify what amount has been retained and what has been sold, and then recognize the right of use asset and the profit or loss on disposal accordingly. This was all with the lease accounting. I hope you have found it useful. Please do a lot of practice of this. We have multiple questions in practice platform, study hub. Please practice this properly so that you can score full marks in the lease part of the exam, wherever it comes up, in whichever section of the exam. So best of luck for that. Thank you.